Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Traders buying pullbacks to the daily uptrend line should use a prior pivot low for a stop loss and the 119.50 area for a target. That means pretty much if you're going to buy 116 and you do take that trade, make sure you place your stop loss below one of the prior day's lows so that you're not taking too much risk on that trade. All right, and we had one of those days here where we did, have an engulfing candle, and a couple of days later we're back up here trying to base again. So we're still holding the trend line. It's amazing, right? I mean, you can draw trend lines on here, and then if the trend line gets broken like this, you can still watch to see what price does and just move the trend line a little bit over and connect it to this low and watch to see if price stays up here, because it's really still finding buyers every time it dips near 116. Okay. The last one here is the dollar versus the yen. And the dollar versus the yen, of course, was one of those currencies where at the time we weren't sure, but we found out that the unwinding of the carry trade was going to affect these currencies in a big, big way. So the yen was rallying against all the currencies, and the dollar was kind of like trying to rally for a while, or actually retrace to what it had lost. So we had a couple of patterns we were looking at. I was going to buy a trend line touch here at about 105 for my first entry and a target of 110. And, of course, we got to the 110 area, so I says, okay, this should be new support. So we were going to say, okay, if we find support, we could take another trade. A couple of days later or weeks later, we actually tested the support and bounced a little bit back towards 110. But at this point now, you could have taken your trade off if you bought at 105, close to 110, because that was prior resistance. And I was planning for maybe a breakout of here like the other currencies were doing, but it just didn't happen, okay? We found resistance again at 110, came back down to 105 where our support level was. And so I said, I'm taking my position off because something's not right here. At that time, I thought the sentiment was neutral. I had support at 105.50, resistance at 110.50, and my next trade in September was going to be a breakout above 110.50 to the upside, or a breakdown entry below 105.50. And at that time, I noticed that this week's closing low, a new ascending triangle, was starting to form on the weekly chart. Well, here's that 110 up here, and here's 105.50 here, and we absolutely collapsed. The dollar started to collapse against the Japanese yen, and the yen was flying to all-time highs. Fundamentally, the reason for that was we're unwinding a carry trade. We've got all kinds of turmoil in the world. People are buying yen, buying back their short positions. So in November, I said, let's use a trading range strategy until either we break out of the 92-100 range to the upside or to the downside. So if we break out of the stage 1 base, which is at between 92 and 100, then we would buy calls to go higher. But if we break out of the lower part, I was going to hang on to my 100 puts. So that was a good thing because we decided to extend the range all the way down to 87.50 or so. Now we're in January here. I'm buying 90 calls, and I'm going to hold on to see what happens. And now I'm going to probably take the trade off if I can get close to the prior resistance levels. But notice at 95, I started to stall out here. So I saw we were stalling out here, and I figured, okay, let's see what happens here. Let's see if we channel between 90 and 95 or 87.50 and 95 for a while. Okay? So we talked about executing a trading range strategy and preparing for either a breakout to the downside below 87.50 or a breakout above 95 for a new breakout. So this is the picture now in November and going into December. We're stuck in this range between 87.50 and 95. I'm buying puts at the top of the range near 95 and buying the calls near the bottom of the range. Okay, so we've got a new range here going. I'm waiting for the 30 weighted moving average to catch up here because it's a few weeks behind. It's lagging, just in case we're going to get another stage 2 breakout to the upside. Notice inside here in the channel, we start to make higher lows like we did the last time. And notice also we've got a possible descending triangle inside the channel in the middle of February. So this is pretty neat because it's the same thing that happened when we were down here the last time with the euro too. We made a double bottom exactly at 87, around 87 and a quarter. We got to the top at 95 here, and this particular week we actually closed above the top of my little trading range. So if you did buy 95 puts because that's your trading plan and it did break out, you can use those 95 puts for some kind of a protection. But you do want to take calls, buy calls on a breakout. My daily chart, I actually based at the bottom of the chart, broke out a few days in February and actually retested the breakout for an entry if I was trading on a daily chart. So things are kind of telling me we want to go higher at that point. We start to make an ascending triangle inside here. We're looking pretty good for going to the upside. And then we just started to break out of the ascending triangle. We're getting up to this 95 area. If you do buy the puts now and you do break out, you've got protection, you've got a stop loss. And then last week, of course, here's our new stage 2 uptrend breaking out at the end of February. And by this time, though, you know, you don't know for sure this is what's going to happen. You're just making plans in case it does. And on a daily chart, of course, now you're starting to draw your trend lines. You're breaking out of your channels. And notice I've marked off resistance at around 100, resistance at about 103 or 107, whatever that is up above. So I'm already planning for places to take profits, drawing trend lines, whatever I need to do to stay in this trade as long as I can, because this could be a nice uptrend for the dollar versus the yen. And that, my friend, is a complete recap of where we were and where we are. And I can't see any questions here because my chat box is so tiny. So if you, Steve, if you have any questions, I'll be happy to answer them there.
Okay, Steve, sorry, I had my box closed also. I think you did a great job because I like how you sequentially went through sort of past slides, what you were sort of describing then, you were forecasting, and then you looked out to see why you were predicting that and what happened, and that was really, really interesting. Let me go through some questions. So, although I want to say thank you on the behalf of the International Securities Exchange because you did a great job. Let's start with some questions. Joshua wants to know, how far do you go out when you're looking at options? You're talking about selling premium or buying premium. You know, if you think something's going to happen in, let's say, 3 or 4 weeks, you trade a 1-month option, 2 months. You know, what are your thoughts there?
Yeah, the problem with the trying to buy the time and everything is that these strategies are taking quite a while to go out. So the farther you want to really go out, probably the better. Now, if you're going to use a short option, you want to come in close as you can, but you want to give these trading range strategies a little time to play out. And then, of course, once you do get a break above these areas, then you can implement you're chasing a little, but you can implement some kind of a trend line strategy.
So you could actually go out. I'm sorry, I cut you off. 3, 4, 5 months. I mean, at the ISC we have them out. The term structure goes all the way out to 10 months, but you wouldn't be adverse to going out 3, 4, 5 months then.
No, and remember, once these ranges start to establish, you saw like in against the Canadian, it was a 9-month affair in the range, then a 5-month affair in the range, and once those trading ranges get established, then you can be flexible with which options you use. But I don't ever buy in anticipation of the breakout. I kind of wait for the breakout, and then I kind of implement that strategy.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.